Guys, there's a term you may have heard of called the blended household rate, and you may be wondering just what that is. We're going to take a look at that in this video today and actually show you a calculation of how a blended household rate comes to be. What it is, guys, is a total interest rate calculation on all of the debt that you have, given all the various interest rates applied to that debt that you may have, to come up with a total blended rate to see if it makes sense to maybe do something different about that than just continue your pattern of paying on the way you are now. So let's take a look at a calculator that we have that will actually calculate the blended household rate for you. This is a blended interest rate calculator. It's an Excel spreadsheet, as you can see. I can send this to you if you want a copy of it to play with and put your own numbers in there. Keep in mind that a blended interest rate is a snapshot of any particular moment there of what the total overall balance is owed and what the total interest calculation is for that. So if you make a payment on any of those debts, such as the mortgage here, and you drop the principal balance by a certain amount because of your payment, that will change the annual interest expense on that particular mortgage, which will change the overall blended rate for the household. In this particular case, we have a mortgage of $300,000 with a 3.75% rate, someone who maybe got a rate the last couple of years. The annual interest expense on that mortgage at that rate with that balance is $11,250. Also, they have a car loan, and you can see they have 4 credit cards here with various interest rates, and those rates are probably not overly high for credit cards. Credit cards have some extremely high rates, and that's what kind of tricks people up, because they're making payments on their credit cards and they can make the minimum payment, and that interest rate stretches out for a long time, and you pay an overall interest expense for the household much greater than if you would have taken another strategy. Perhaps a snowball approach and paying them down much more rapidly is the way to go here. Perhaps a home equity line of credit on your home to get some funds with a lower interest rate on that, pay off all the credit cards, and then aggressively attack that home equity line of credit payment to pay it down. Perhaps a refinance into a new first mortgage with a higher interest rate to get enough cash to pay everything off still make sense. The way this calculation works here is fairly simple. It takes the total balances of all of the debt, which in this case is $404,000, with the total annual interest expense on that debt of $29,000, and calculates a blended rate from that with those numbers there of 7.34%, much higher than somewhat households think, because they have that low 3.75% and they're reluctant to do anything about that. And it may be, as I said, that you don't want to touch that mortgage, but it also it might be a better strategy to refinance into a higher rate and then aggressively take the savings and pay down the mortgage and save yourself a bunch of interest over time. In this particular case, we separate out the auto as well, because it has a 6% rate, and included just the credit cards and the mortgage in here with that total debt, with the total interest expense on those, and you can see the blended rate is 7.42%. So again, if you would like a copy of this spreadsheet, just let me know. You can put your own numbers in. We'll be happy to help you with that, and we'll walk through your situation if you would like to see what your blended household rate is and see if there's anything you want to do about it. Thanks, guys. Talk to you later.